Starting with the good news. After the disruptions in the banking sector in March, we have not seen further shockwaves coming through the system ever since. We have also seen in this environment that capital markets improved, and this led to a calm down of the situation. On the real economy side, we also had some good news. With the end of the COVID restrictions in China, the first quarter Chinese growth came back, and we saw that the global problems in the supply chains were reduced substantially, allowing that particularly in Europe industrial production is coming back and the very huge order backlog in the industry is worked down. However, we have seen that the events in the banking sector left some scars. The funding costs for banks have increased, and this is likely to lead to some further tightening in financing conditions for companies and private households. And this is likely to dampen economic activity in the course of the year. So, while this very good start of the year points to higher growth in 2023, the slowdown in economic activity in the mid of this year and probably a weaker recovery thereafter points to a slowdown or a weaker economic development in 2024. So we revise up our forecasts for the euro area, for Germany, for the US, for the global economy for 23, but we rise down the figures for 24. In this environment, inflation nevertheless remains sticky and high. And therefore, the Fed is likely to go on with one further rate hike in May, but then that's probably it. And the ECB is likely to go ahead with even 2 further rate hikes in May and in June. In this environment, inflation is likely to come down, but it's not likely to be there where central banks want to have it in any time soon. In this respect, the expectations of early rate cuts, both by the Fed and the ECB, are overdone. And this probably will lead to some corrections in the prices for riskier assets in the second half of the year.